Understanding leasebacks, a comprehensive guide. A leaseback, commonly referred to as a sale-leaseback, is a financial arrangement wherein a company sells an asset, such as property or equipment, and then leases it back from the buyer. This structure enables the seller to raise capital while retaining the ability to continue using the asset that is crucial for business operations. In this article, we'll delve into how leasebacks operate, who uses them, their potential benefits, and an illustrative example to clarify the concept. How leasebacks work. In a typical sale-leaseback agreement, the seller of an asset becomes the lessee, while the purchaser of the asset becomes the lessor. The details of the lease arrangement, including lease payments and the duration of the lease, are established immediately following the transaction. The main advantage of this mechanism is that it allows businesses to convert fixed assets into working capital. When a company sells an asset, it receives cash upfront. Subsequently, by leasing the asset back, the company can continue to utilize the asset without the burden of ownership. This arrangement can be especially appealing for firms that need immediate liquidity without taking on additional debt. Who utilizes leasebacks and why? Leasebacks are particularly common among companies with high-cost fixed assets, such as real estate, machinery, or specialized equipment. Industries frequently using sale-leasebacks include real estate. Developers may sell properties to investors and lease them back, allowing for cash infusion for further projects. Transportation. Companies may sell and lease back expensive fleets of vehicles or aircraft. Construction. Builders may opt for leasebacks on construction equipment to enhance cash flow. Aerospace. Major manufacturers may find leasing more favorable for specialized and costly assets like airplanes. Companies often choose leasebacks as a way to free up capital tied in assets. Rather than incurring debt by taking out a loan or diluting ownership by issuing new equity, leasebacks offer a middle ground. By selling off assets, companies can reduce liabilities on their balance sheets while boosting cash reserves. Benefits of leasebacks. For the seller/lessee. 1. Tax deductions. Lease payments can often be deducted as business expenses, providing tax advantages to the lessee. 2. Business expansion. The capital raised from the sale can be reinvested in business growth, be it in the form of new projects, hiring, or research and development. 3. Improved balance sheet. Leasebacks can improve financial statements by reducing debt levels and increasing cash reserves, enhancing the company's attractiveness to investors and creditors. 4. Risk management. Owning and maintaining an asset can carry risks. Leasebacks mitigate this by transferring ownership and associated maintenance responsibilities to the lessor. For the buyer/lessor. 1. Guaranteed lease. The buyer can secure a long-term income stream through the lease agreement, which provides more predictable cash flows. 2. Fair ROI. Lessor investors typically negotiate a reasonable return on their investment, making leasebacks enticing investment opportunities. 3. Stable income. The continuity of the lease creates stable income for the lessor, especially if the lessee is a stable and reputable company. A practical example of leaseback. To better illustrate how leasebacks function, consider the scenario with a commercial bank. Initially, the bank owns multiple safe deposit vaults used for storing customers' valuables. In a sale-leaseback transaction, the bank sells these vaults to a leasing company at a market price that exceeds their book value. Following the sale, the leasing company subsequently leases the vaults back to the bank. The bank can continue to provide secure storage to its customers while benefiting from the immediate cash influx from the sale. This fluid cycle of buying, leasing, and subleasing exemplifies the potential of leaseback arrangements in a straightforward manner. Conclusion. Leasebacks are a versatile financial strategy that can yield numerous advantages for both sellers and buyers. For companies seeking to maximize cash flow and operate efficiently with significant assets, leasebacks offer an opportunity to convert owned assets into capital while maintaining operational control. As with any financial transaction, it is crucial for all parties involved to fully understand the business implications, tax ramifications, and inherent risks. Proper planning and expert advice can make sale-leaseback arrangements a valuable component of corporate finance strategy.